Hey everyone, thank you for joining today. We're going to give our attendants about 60 to 90 more seconds just to get any more stragglers, and we'll get started right away. All right, I think we'll get going. So again, thank you everyone for joining us. We're really excited about the webinar today. As you can see, we're going to go through a little bit of an economic overview, and then we're going to dive into an Ask Me Anything. So my name is Marie. I lead our client success team over here. And then before we get started, I will also just make a couple of notes. So after this webinar, we will be sending over a recording as well as the presentation that we'll be going through. There will be some additional slides added on at the end of the presentation just to provide you with some more information. We might not get to those today. We'll also be providing you with our new Economic Outlook white paper, as well as the recording, which I believe I said. As we go through this, please feel free to submit any questions. Like I said, we are going to be going through and Ask Me Anything later on. So we really encourage you to shoot us over anything that you're curious about, and we'll get you those answered. So Ryan, next slide. Our two speakers today are Scott Gabehart and Ryan Thompson. So Scott is our Chief Valuation Officer. He is the big brains behind BizEquity over here. And then Ryan joined with us earlier last year, and he's our Director of Valuation Support. He's been a huge addition to the team, and we're really lucky to have them both. I think without further ado, you guys can take it away.
All right, thank you, Marie, and welcome to all the attendees today. We will be running through a number of slides today that will provide some perspective on the current macroeconomic climate, and followed by a quick overview of some recent trends in private firm valuation multiples and deal count. And then, of course, we'll conclude with answering any questions that you happen to send in. And in the event that we don't get to all of the questions, we'll be sure to get to them for you via email if necessary. All of these different white papers will also be available subsequent to the presentation. All right. Well, everyone is aware that the last 3 years have been extremely unique in terms of our country's history and our macroeconomic history as part of that. And we find ourselves at the beginning of 23 with what seems to be a fairly low unemployment rate at 3.5%. However, it's also the case that literally millions of people have left the workforce during this 3-year period, which tends to overstate the understate the true unemployment rate. And there's such a thing as the U6 unemployment rate, which accounts for part-time workers and other aberrational situations. And that rate actually rose in January from 6.4 to 7.4%. By most measures, inflation is the primary economic concern as we move on into 2023. And of course, related to the battle against the inflation has been rising interest rates, which has had myriad effects, not only on the cost of cars and homes, but also the cost of borrowing for businesses. We're running at around a 6 or 7% rate currently. And the next slide will provide us with some historical perspective. As you can see, the last time we had inflation in the 7% plus range was back in the 1970s. And the 1970s were a very unique time frame in our history, where we had two different oil embargoes, 73, 79. We had literally a runaway creation of regulatory agencies during the 1970s. There was, similar to today, great political uncertainty as Russia had invaded Afghanistan and placed troops in Central America. And literally the inflation rate were in double digits in the late 70s, and well ingrained into the psychology of workers and consumers. And as a result, it took extreme measures to battle that inflation. And as this chart shows, inflation has been trending down steadily, beginning with the 80s. And the 1980s were unique in that we ushered in supply-side economics, tax cuts to spur labor and investment, deregulation instead of re-regulation. And of course, the prime rate went over 20%. So it was a heavy cost to pay to get rid of that inflation. And the question today is, are we in a similar boat as we were back then? And is it going to take 10 years to wean this inflation out? Probably not. It's already trending downward slowly, and interest rates are continuing to go up marginally. So I don't see that it's identical in any way, but it's still a significant issue. And the next slide will help us understand why we've had this inflation. They say a picture is worth 1,000 words, and here we can see what happened to the M1 money supply right after COVID hit. It literally went off the charts. Never in our history has the M1 money supply grown like that in such a short period of time, from less than 2 trillion to more than 7 trillion. And of course, M1 is a measure of the most liquid measure of money in the economy. It's checking accounts and cash. And there's no surprise, therefore, that with all this money injected into the system, that prices would rise as a result. But it wasn't just the quantitative easing by the Fed that has created this inflation. The next slide will provide some perspective on how aggressive the federal government was in spending and borrowing money. More than $5 trillion, 6 bills, 43 federal agencies caused the national debt to rise by 20% in 1 year alone, 2020. So when you couple the rapid growth in the money supply with unprecedented federal spending in what they used to refer to as crowding out, the government spending was crowding out private investment. It's not a surprise that we've had this inflationary run. But the next slide, well, that's okay. What I wanted to say was, Forgive me. I'm missing a slide there, so I apologize. I got a little bit off track. But the question now is, are we in a recession? Technically, no. The National Bureau of Economic Research is the official arbiter of the business cycle, and they did stipulate that we were in a recession during the second quarter of 2020 when COVID hit, but they tend to be retroactive in perspective, so we may not know that we're in a recession until 6 to 9 months after we are. We had negative GDP growth in 22. However, the fourth quarter of 22 showed growth at 2.9%, which is not too far from kind of a longer term average. But there are many signs that the economy is softening relative to that level of growth. So I would expect smaller growth numbers going forward. We've had a yield curve inversion where the interest rates provide a predictive capacity as to recessions. And we had the inverted yield curve as of July of 22. And each of the previous 7 recessions also had an inverted yield curve. So that's a pretty good sign that we are still in choppy waters. The volatility index involving public stock investments is right at that level, which tends to be predictive of a recession. All right, and next slide. So this is actually what I was looking for previously. It's not just the money supply growth. It's not just the unprecedented federal spending, but we've got all these other issues that created a perfect storm for inflation. The supply chain disruption, no semiconductors coming out of China. The Ukraine conflict, which has caused difficulty in getting fertilizer and caused food prices to rise. Energy, we went from an oil exporting country to an oil importing country, with the end result being less supply of oil domestically and higher gas prices. So all of these factors together have kind of led us to where we are, and we can go to the next slide now. Most economists seem to feel that we are still, in fact, heading for a recession. Some of these numbers are as follows. They're expecting the unemployment rate to rise up to 5.2 from 3.5. The 10-year Treasury will hit 4%. 2 out of 3 economists economists are predicting the recession odds at 64%. So 2 out of 3, we have a recession. Same thing, 2 out of 3 say that the Fed will probably not cut rates until 24. And I've seen a number of analyses that are consistent with that. So I would expect interest rates to continue to rise marginally over the next 6 months or so. Sentiment is leading towards a recession, and most economists believe that a recession, if it does materialize, will be mild and short-lived. Certainly much milder than we experienced during the shutdown. Inflation is still with us, and I feel that it will be an issue for the next year or longer. And Of course, that will make it a political issue at the time of the next election. And for example, as you may remember, Jimmy Carter rolled out the misery index back in '76 election when he beat Gerald Ford. And the misery index is the sum of the inflation rate and the unemployment rate. Well, 4 years later, Ronald Reagan used that same misery index to become elected president in 1980, pushing Carter out. Interestingly, the misery index was at a near record low level at the end of 2019. So everything really truly was going very well for us prior to COVID. And of course, since COVID, the misery index has been above average, and even though the unemployment rate is still officially low, it's still over 10%, and the 24 election should be quite interesting. Okay.
All right, I think it's on to me. So thank you now, Scott. Really good information there around the economic landscape. So now that we have that more macro level background, we can zoom in a bit and take a look at the current activities and sentiment within the private company realm. So how is deal activity moving? How are multiples moving? But first, if we take a look here at this chart, right, this is some information provided by the SBA, the Small Business Administration, and it indicates that the number of small businesses in the U.S. is rising. So currently there are about 33.4 million small businesses in the U.S. In fact, small businesses make up more than 99% of all businesses in the U.S. So pretty large number there. And while that the criteria can vary by industry of how the SBA defines a small business, generally a rule of thumb is that it's an employer, or excuse me, a company with less than 500 employees. And again, based on additional information by the Census Bureau, more than half of small business owners are more than 55 years old. So, the reason I bring this up is this trend is pretty favorable for advisors, considering that business owning clients have a greater need for financial advice due to their complexity. And again, so more small businesses means, more clients potentially in the future. We can continue to look at some of this activity here, moving on with this theme. The number of new business applications has been, relatively soaring over the last couple of years. So one surprising outcome of the pandemic was that, we saw a pretty steep rise in the number of business applications that were being submitted. It's likely driven partly by, layoffs and furloughs, where employees responded by starting their own businesses. If we look in, a more recent view there toward 2022 on the chart, we can see the total monthly business applications averaged about 425,000 per month during 2022, which is considerably up from 300,000 pre-pandemic levels. Another thing that's pretty interesting, there's a sort of side hustle culture in the millennial and Gen Z generations that's also likely adding to this increased job growth, or excuse me, this application growth. With the ease of the internet and connectivity of social media, we're seeing that more small businesses are kind of emerging to sell products, courses, and become influencers. So again, another kind of area that advisors can be wary of, or at least a trend that it can be wary of, or heads up on that these businesses are potential clients. And just a little bit more. Again, we have about 3 slides here on this kind of emerging business statistics. Really, the important points here are that by July 2020, the new business applications reached more than 550,000 per month, representing an 80% increase over the previous record of 309,000. So really meteoric rise in the number of small businesses kind of coming out. This could be partially offset if you think about the potential closers from the COVID. Small businesses that had to close their doors because they couldn't meet the necessary financial obligations. So again, a little bit of a caveat there. But then applicants that are likely to become employers are also ticking up. This is interesting just because of the effect that small businesses have on local and macroeconomics. Again, we said that they make up 99% of small businesses. So the fact that they become employers is pretty important to really the overall economy. And then again, more businesses employing people can be beneficial to the economy, and they are likely to become larger in size, which means more complexity, which means more necessity for some outside professional advice. Now, if we move into what the multiples and deal activity has been looking like, where it's really going. So really the emerging trends in the private firm transaction and M&A space. So if we take a look at this chart here, this comes from GF data, and it really provides information based on private equity activity, typically in the middle market realm. So we could dive into this chart a bit, and one of the first things that stands out is that in the fourth quarter of 2021, there was 172 deals, right? And if we move down toward the fourth quarter of 22, we see that drop rather dramatically to 64, so nearly a third of what it was the previous quarter. So, going forward, deal activity is slowing, right? We see that trend throughout 2022. This can be contributed to many different factors, really just kind of market sentiment, right? People a little bit wary of investing in the new businesses and in the market, to rising interest rates, right? So the cost to borrow is increasing, so now the ability and capacity to purchase companies is kind of diminishing. And additionally, over this time, we can see that EBITDA multiples fell from about 7.5 times EBITDA in the fourth quarter of 2021 to 6.8 in 2022, and that also represents a pretty steep change in the purchase prices that are going to be occurring in some of these businesses. And then GF data, kind of what I just said in 2022, they're saying that the increased macroeconomic uncertainty and increased borrowing costs are leading to this retreat in multiples. And what does that look like for the future? Well, really, given that the current economic landscape has not really significantly improved, so far in 2023, we'd expect that multiples are going to remain, more toward that fourth quarter 2022 level. And then, another interesting thing to note is there has been a rising quality premium that has begun to appear. So companies that are viewed as above average, meaning that maybe they're larger, cleaner records, more profitable, they're obtaining higher multiples still in the market today, whereas average or below average companies are experiencing lower purchase price. And that might sound a little intuitive, but over the last 2 years, we've seen below average or average companies still demanding higher multiples, just because kind of just the landscape of it was a hot market, right? So this is a pretty interesting reversal, which might mean that sellers are kind of losing their upper hand that they seem to have had.
And Ryan, let me add something there specifically related to wealth advisors. And this is a quote from a wealth advisor. Well-run businesses are the real gems in the wealth management space. Some smaller wealth management firms may face operational challenges in a tight macro environment, and that may lead others to seek a bigger, well-resourced home. In rocky times too, well-run businesses prove themselves to be invaluable to their clients. And the point, of course, being that that premium for quality is something that I've seen in various ways from various analysts, that you have like a bifurcation of those quality businesses selling for higher than that average multiple, and the lesser quality companies selling for lower multiples and or not selling at all.
All right, thanks for that, Scott. Really good insight there. I think that's kind of segue us into this next chart here too. So we were kind of looking at just some private equity deals there on the last slide. This comes from Deal Stats, which has tends to have more of a focus on smaller to middle market firms. And again, that was based on EBITDA, this being based on seller discretionary earnings, just a couple of differences to highlight. But still some interesting nuggets we can kind of pull from this chart here. So if we dive in a bit, toward the bottom, we have companies with under $1 million in earnings. So, across really the last decade, we can see that, this segment of companies has remained relatively stable. This suggests that average multiples for small companies are rather consistent over time. One caveat is that, industry multiples, so industries within even that segment do change over time and become more volatile. It's just, important to note that industry multiples do change. So as we move up the chart, we start getting bigger and bigger companies. You can even see the spikes and how they, get a little bit more scale to them. So that volatility starts to creep in. So this provides, some additional evidence that average multiples for small firms don't rise or fall in the same manner as, the larger we get. So this kind of helps highlight what's known as the size premium in business valuation, where, all things equal, smaller firms tend to sell for lower multiples, while larger firms tend to sell for higher multiples. And again, we're kind of, we're looking at private company transactions, but, we can kind of, pull some items that compare to public companies, right? So a lot of people are familiar with valuation, mostly from trading public company stocks, but it's important to notice the differences in the way they behave, right? So public company stocks are much more volatile. If we think back to even as recent as 2021, I'm sure everyone's pretty familiar with GameStop, the rise and the fall. It rose meteorically, before kind of taking a fall. Whereas, in private company valuation, you don't really see that type of swing. And a few reasons why is that, we have, optimism of an analyst, right? So outside influence, on companies from professionals and stock analysts, optimism or lack thereof, and the changing hands of large institutional holdings and investments is really going to weigh in on, a stock price in the public market, whereas in private, it's much less influenced by that outside noise. And then again, another, kind of echoing the same things. We're going to have a couple different, charts here that kind of, really bring it home. So we've seen how average EBITDA multiples have been trending. And then again, we can see it here as well that, since 2016, right, it's kind of a downward trend. We did have a spike up in 2018, which is really a high of about, 5 times EBITDA. But since then, we've seen it retreat, right? And if we look, to the right in Q1 and Q2 of this year, we can see that, it fell pretty substantially, or excuse me, of last year, it fell pretty substantially. And then, but more importantly, we can be, things can be kind of skewed and things just from watching, each quarter. But if we watch that 3-quarter trailing average, we can kind of see that multiples, the sentiment is weakening, for businesses and the value that they're getting. And, it really is saying that multiples are softening. So as we think into 2023 and what does that look like? Well, we do think there is some optimism on the way, right? Probably in the second half, perhaps once rates start kind of going, the interest rates start going down and the cost to borrow becomes a little bit cheaper, right? More activity will start happening and maybe we'll see those multiples tick up a little bit. But realistically, this seems more of a return to the norm, right? During 2021, we had pretty substantial deal activity and, for some companies really, heightened multiples. So now that seems to be slowing down, it's really that we're returning back closer to the average. And again, we have some, a few highlights here, expectations for 2023. Again, we anticipate it being pretty much in line with the second half of 2022. One key factor to watch that'll affect activity multiples is based on the Fed's monetary policy. If interest rates continue to rise, it's likely that multiples will, depress further. But if they start to ease up, markets will become more optimistic. And those who are currently waiting on the sidelines are likely going to start jumping in at those opportunities. And then, despite economic background noise, some companies with strong financials in 2023, despite the economic landscape, they're still going to see strong multiples, right? Kind of what we referenced a couple slides ago. These companies will appeal to buyers such as private equity, and they're likely to see an increase in offers and higher valuations as well.
All right, well, thank you, Ryan and Scott, for that information. I think especially with a lot of the uncertainty moving forward in the next couple of quarters, it'll be interesting to see how a lot of those metrics change, especially the multiples and how the economy really impacts valuation. So thanks again. I do want to, so I'm looking over at the questions some of you have submitted. So if anyone else has questions, please don't hesitate to submit those. We're definitely really excited for the Ask Me Anything portion of this. It's something we haven't done before. I do have a couple here just to get us started out. So the first one that was sent in is, at a high level, what are the primary factors that impact the value of a company?
Okay, I could take this one. So, I think we also have some white papers and stuff to discuss this as well, but, at a high level, really what makes a company value, right, or in evaluation, the 3 key factors are going to be, the profitability, right, the cash flow, how much is it generating, and the size of that cash flow, growth and risk. So, again, when we talk about growth, growing companies sell for more than non-growing companies. That seems a little bit intuitive, and as well as risk too. And they kind of go hand in hand, right? Growing companies, in some cases provide less risk because that cash flow, if I'm a buyer and I'm looking at it, I know that it's going to continue to rise, or it should rather, as long as the growth plans are accurate. And then the risk of the company, and in any of those factors, there's a myriad of sub factors, right? And we take some of those account in our tool as well, such as, the owner, key person risk. If the owner were to exit the business, how damaging is that to the operations of the business? Recurring revenue, how much is that? What's the risk of that? If I buy this business, is it going to recur next year? The margins of the business, how profitable has it been historically? What direction are those margins headed? And then, some typical industry benchmarks, such as, what is the fixed assets or the inventory look like, compared to industry peers. So really, there's tons of different factors that impact the final valuation. But really high level, they kind of remain close to cash flow, growth, and risk.
Yeah, definitely. I think we also might have some white papers that discuss that. So I'll look into seeing if we can send those over in the follow-up as well. So another question that we got is, how accurate is the BizEquity tool?
Okay, I'll take that one. Well, that's a great question, and of course one that we get often when dealing with prospective clients. And the first thing to understand is that there really is no such thing as the value of a company, and there are many reasons for that. First of all, it depends on what are you valuing, on what basis. Are you talking about an equity value, or an enterprise value, or an asset sale value? Small business owners have two options when they sell their business. They can either do a quote unquote asset sale, or a quote unquote stock sale, equity sale. And they're different. They're different as to the bundle of assets and liabilities that are included in that number. So not only is there the issue of what's being valued, the value will change often significantly over time. So even looking at a valuation from a year ago could be an issue. Now, on top of that, the reality is that business valuation is both a science and an art. Yes, there are generally accepted valuation principles and procedures, which our tool does in fact incorporate. But every appraisal, every valuation ultimately is an opinion. It's an opinion of value based on the facts and generally accepted accounting principles and procedure, or valuation principles and procedures. But ultimately, it's an opinion. And the way I'd like to explain it to prospects is that our valuation estimate, not 95% of the time, will fall within the range of what you would see if you hired 5 professional appraisers, provided them the exact same fact pattern, and they came up with 5 different estimates. And in a typical case, if you did hire 5 appraisers, what you'll end up with is a mean estimate around which the standard deviation is 10 to 15%. So even same fact pattern, same accepted procedures, there's going to be a range in the value estimates, and none of them can be determined to be correct or the correct estimate. They're all based on literally layers of assumptions that go into that final number. But in terms of kind of supporting the reality that our tool is accurate, I think the best evidence for that would be that we have been vetted, reviewed, analyzed by a literal who's who of financial service companies. Wall Street Journal, KPMG, all the major insurance companies, commercial banks, TD Bank is one of our big clients. They all went in and compared our results to whatever appraisals they might have had access to, and we've done very well, and therefore they've become clients. And then finally, the icing on the cake is our retention rate of around 90%. So our customers stay with us in part because the tool is accurate, and it's accurate within the context of what I just described.
Yeah, I can definitely attest to that too. A lot of the work I've done with our clients, a lot of times if they do end up getting a certified valuation later on, it is right in line with the BizEquity valuation. So that's always fun to see. I'm going to do a last call for questions. I know we're a couple minutes over here, but I do have one more before we jump off. So either Ryan or Scott, either of you could answer this, but what is the importance of valuing a business during an economic recession, and how do you encourage business owners to focus on valuations during that time?
I can answer if you want,
Go ahead,
Scott.
Brian. Go ahead.
Yeah. So valuing a business during a recession, I mean, I would argue that it's, extremely important, right? I think clients might be hesitant to say, they're not worried about looking at the value now. Perhaps, they believe it's down, and maybe it is. But I think, getting, what we could call a report card on your business is one of the best ways to be successful in growing the value of your business, right? There's a quote out there, what gets measured gets managed. I think it's a little controversial, but it's got, good roots. And, if we're looking at it, right, so if we go into this and, you take a look at, a client wants to take a look at their valuation today, I think that's good. And it gives them a good level set where they are. And then from there, they can say, maybe it's not what they expected, or maybe it's above what they expected, and they can make other decisions off of that. But they can dive into the components. Like we mentioned, we have other resources that talk about, the different components of what goes in your value, how to increase your, your cash flow, or maybe your growth or risk, or all those different components. But they can hone in on those, or take a look at KPIs or ratio analysis, but at least they have a starting point of to where to begin. So I think during a recession, it's the utmost importance, because it kind of lets you know where you're at and exactly how your business is being influenced from the outside factors.
And Ryan, let me add to that by just stating that here at BizEquity, we're working diligently on improving the tool and the report in various ways. And one of the new components that we'll be introducing sometime this year, 2023, is an optimization component. So in the big picture, our company tagline is discover, monitor, and optimize. So we now allow you to discover the value of a company, and you can monitor the value of the company by running valuations once a year, once a quarter, whatever is required. The last part of that moniker, optimize, is essential, I think, for giving advisors the full set of tools that they need to be the very best advisor they can be. I mean, being able to offer a valuation to a client at a reasonable cost in and of itself is valuable, but we have some exciting plans for the optimization component, which will be forthcoming later in this current year.
Thank you both for that. Last couple here. So how important is solid sales and marketing infrastructure in valuation?
I'll take that one, Ryan. Well, obviously, to the extent that that's what's driving revenue, it's essential. But in terms of actually valuing any company, the proof is in the pudding, so to speak. So what you would like to see is that because of the strong sales and marketing infrastructure, the revenues are higher and or growing, as are the profits, the discretionary earnings. Is there an absolute and common direct link between just that factor and business value? In reality, yes, there is, but it would be more so captured in the development of a multiple or a capitalization rate or a discount rate, and or projections of future cash flows. If, for example, there was a new marketing campaign and there was valid reasons to suspect that is going to drive higher revenues and cash flows, well, a discounted cash flow model would capture that element. Certainly revenues are key, and that's driven by the sales and marketing infrastructure. And no doubt it's important, but it would literally come down to each particular situation and the evaluation of the particulars.
Got it. Okay. One last question here. Can you explain the different tax implications of an asset sale versus stock sale for the buyer and seller? Why does estate valuation typically use equity valuation versus asset sale?
Okay, I'll try that one. All right. Well, so yeah, this gets back to what I said earlier. When a business owner decides to sell, there are two options: an asset sale or a stock sale, equity sale. In an asset sale, the buyer and seller must agree upon the allocation of the purchase price across 7 distinct and well-defined IRS categories. So you've got 7 categories of assets. The purchase price is $1 million. It's going to be allocated to fixed assets, inventory, accounts receivable, trade name, goodwill. And generally, what's allocated to goodwill will be treated as a capital gain. Allocations to accounts receivable would possibly be subject to ordinary income tax. So it's a little bit convoluted in an asset sale. In a stock sale, it will be based upon the comparison of the basis in the investment versus the purchase price, and the difference would be typically a long-term capital gain. And the reason why exit planners and estate and gift tax valuations revolve around the equity value is that that is in fact what's being bought, sold, or transferred. And so in other words, if you want to give 10% of your company to your son, you could give them 10% of the asset sale value. And I've seen that done maybe 2 times in 30 years, but it's much easier and more likely that you're going to transfer 10% of the equity, which means 10% of all the assets and all the liabilities, known and unknown. 10% of the ownership equity itself, as opposed to the assets, quote unquote. So I think I answered that.
I think you did. And if anyone else has any other questions, please feel free to send them over to support@bizequity.com after this, and we'll make sure that we get them answered. But I think we're going to wrap it up there. So Scott and Ryan, thank you again for all of the great information today. And thank you again to everyone that attended. We're really excited about this, and we'll be sending you over the recording, some of those white papers, as well as this presentation in a follow-up email. I think that's it. Any last notes, Ryan or Scott?
No, thank you, everybody.
Well, I would just encourage you, if you have an interest in BizEquity, or if you're a current user and you have valuation questions, I'm also open to speaking to any of you about whatever topic might arise. So thank you all for listening.
All right. Thanks again, everyone. Talk soon. Bye.
Bye.